Hello friends, welcome to today's session. Today's session is specifically going to be dealing with deferred revenue expenditure. Now in my previous video where I had discussed in detail about revenue expenditure and capital expenditure and how they are different from one another. If you have not yet watched that video, please do watch that video to understand the meaning of the term expenditure and the distinction between those two so that you know that there is a third category of expenditure which we are discussing today, that is the deferred revenue expenditure. Now basically, deferred revenue expenditure means an expenditure which is basically in the nature of revenue expenditure. Means you refer to that video, you'll be able to see that revenue expenditure is expenditure which you are incurring. You're spending the amount so that you can generate revenue. It is for the purpose of generation of revenue that you're incurring those expenditure. So this deferred revenue expenditure is also basically a revenue expenditure. But however, it gets classified under deferred revenue expenditure because of certain unique characteristic it possesses, which makes it different from your regular revenue expenditure. Now, the point of difference is that when it is a revenue expenditure, I had clearly explained in the previous video that the benefit you get from that revenue expenditure gets consumed within that particular accounting year when it is incurred. But this type of deferred revenue expenditure also gives you benefit, but the benefit that you get from the deferred revenue expenditure accrues over more than one accounting year. Means you don't get benefit in just one accounting year, but it might extend to 2 years, 3 years, 5 years. So that is how it becomes different from revenue expenditure, that you get benefit over a longer period. Now, when it is a deferred revenue expenditure, as I said, the benefit is going to be extended over a number of years. Therefore, the expenditure incurred is also not directly debited to the profit and loss account or written off or charged in the year in which it is incurred, but usually it is written off over the number of years when the benefit accrues. Means suppose you spend certain amount which comes under the category of deferred revenue expenditure. That is, you're going to get benefit from that expenditure. Suppose you've incurred 3 crores of rupees of expenditure from which you're going to get benefit for next 3 years. Then you will write off that 3 crores over 3 years. Means each year 1 crore will be written off, charged to your profit and loss account. So that is the accounting treatment related to deferred revenue expenditure which you need to know, which is different from your revenue expenditure. Because in revenue expenditure it is written off in the year in which it is incurred, in the year in which you get the benefit. But here in deferred revenue expenditure you are splitting it because the benefit is going to be spread over a number of years. Therefore, the expenditure also is going to be written off over the years when you get the benefit out of it. So that is deferred revenue expenditure. Now, where do you show the deferred revenue expenditure? Now see, you are not writing off the entire expenditure incurred off in the year in which it is incurred. Therefore, whatever portion you write off, that would come into the profit and loss account. On the debit side, it will be charged as an expenditure to ascertain the profit. What about the portion that is not written off, in respect of which you are going to get the benefit in the subsequent future years? In respect of that amount which is not written off, you would present it in the balance sheet on the asset side as deferred revenue expenditure. But basically, from this, you also have to know that this deferred revenue expenditure is a fictitious asset. Now you have learned about the different classification of assets like tangible asset, intangible asset. Now there's the another category known as fictitious asset. Now, what is fictitious asset? This deferred revenue expenditure is a fictitious asset. Fictitious asset means what? Fiction is fictitious is derived from the word fiction. Fiction means what? Which is not real. So here also deferred revenue expenditure is shown on the asset side of the balance sheet, but it is not really an asset. It is fictitious asset. Just because it is shown in the balance sheet asset side, it gets classified as an asset, but it's not a real asset in the nature of other assets like tangible and intangible asset. That is why the term fictitious asset. So you understand that fictitious asset example is this deferred revenue expenditure that you incur. Now, a very good example for deferred revenue expenditure is a huge advertisement expenditure which is incurred. Normally, when there is a product launch, a new product is being launched in the market. Like you have varieties of chocolate coming up every time, variants, like you had Silk, then Bubbly, then Oreo. So like that you had variants in that chocolate. Or it might be a new version of a motorbike or anything else in chips or in any other item. When there is a new product being launched in the market, you would find, if you're a watcher, you watch TV or any videos, you will see that sometimes you find that the same product is advertised back to back again and again. You would watch that. By the time you watch 30 minutes, you would have watched that advertisement coming in between at least 5 to 6 times. So now you know how much amount of advertisement expenditure is being incurred here. So a lot of amount is being spent on advertisement expenditure here. And this expenditure is basically incurred because of this new product being launched. A market is being created for that. And that is going to lead to a demand for this product. You spend that huge amount on advertisement. Suppose in the year you are incurring 5 crores of rupees on advertisement of launching the new product. But you're not going to be getting the benefit of that 5 crores in the same year in which you have incurred that advertisement expenditure. You will be creating a demand for the product, maybe say over next 5 years, you can have an continued demand for that product by incurring this 5 crores of expenditure. Then under such circumstance, the benefit of this 5 crores is to be written off over 5 years. Means every year you would write off to your profit and loss account on the debit side as advertisement expenses 1 crore. So the first year you write off 1 crore because you expect that over 5 years you're going to receive first year 1 crore. You will write off. Rest of the 4 crores would go into your balance sheet. In the asset side, you will write as deferred revenue expenditure, advertisement suspense account. So whenever you find that advertisement suspense account under the deferred revenue expenditure, you know that it is a fictitious asset. The benefit of this 4 crore is going to be available in the next 4 years. So the next year, the second year, again you will write off 1 crore and you'll be left with 3 crore in your balance sheet. The next to next year, 1 crore written off, 2 crores. Like that, by the end of the fifth year, the last 1 crore would also be written off in your profit and loss account against the revenue that is generated. So this is how deferred revenue expenditure is treated and it is accounted for in the books of accounts. So I hope with this example and explanation, this concept of deferred revenue expenditure was clear to you. And if you found this video useful, helpful, please do like and share it. And if you have not yet subscribed to the channel, please do subscribe to the channel and also watch the videos related to revenue and capital expenditure and the distinction between that so that you understand this particular video also clearly. So with this, the classification of expenditure into deferred revenue expenditure, the capital revenue expenditure concept has been covered completely. So I hope it was helpful to you. Thank you.